This property is 11-057. It's in Texas, and it is a bank REO. So it's an all-cash transaction to the bank, but of course it's 93% occupied, so it qualifies for traditional financing with 25% down, 75% loan to value. Now this is a property where we found a few anomalies in the expense columns. And we'll point those out to you later on. But right now, let's take a look at the offering of Texas 11-057. Let's see what it looks like on the offer.
Okay, this is Texas property 11-057, and it has some interesting issues going on with it. It's 373 units. The purchase price is $6,450,000. They want 25. We have to do a 25% down payment. It is a bank REO, and they're trying to get rid of it. So $1,612,500 is the down payment with a regular mortgage on it of 5.1% for 30 years. So all of our acquisition costs and everything else put in means the final investment at the beginning here is $2,165,750. As we go down, our percent of asking price is 75%, so our initial loan will be $4,837,500, 5.1%, 30 years fixed. All right. The income here is taken from the 2010 actuals. We have 217 units, 1-on-1. At 481 and 156 2-and-2s at 651 for a total 373 units. The total rent there would be $2,471,196. Our gross rental income is $2,456,145, plus the other income is the laundry and all that kind of stuff at $338,522. So our total gross rental income is $2,794,667. The vacancy and credit loss is 7%, $171,930. But here are the other losses: $488,722, and that's among various things that we'll get into later. So that means our gross operating income is all the way down to $2,134,015. Now, these other losses up here of $488,722, those are the things that we are going to mitigate either in escrow or post-acquisition. Coming down to the expenses, everything looks pretty much even here, except that we're going to take care of some things. That payroll number there of $429,737 is really high. The per unit industry average for that is $750 a unit, so we'll cut that down. Repairs and maintenance is high. It's supposed to be right around $330 a unit. The electric bill is a little bit high. We can cut that down by doing a fixed contract, and we'll talk about that a little bit later. So our net operating income is $469,738. Annual debt service on the 5.1% 30-year fixed loan is $315,182. So our annual cash flow is $154,555. Our cash-on-cash return there is 7.14%. But the operating expense ratio, now I'm having a little trouble with my internal rate of return calculation, so I'm going to blur that out. But the operating expense ratio is a staggering 77.99%, and those are the issues that we are going to address to make this property work.
So those are the numbers on the offer. Doesn't look all that great, but it does look promising. So let's see what we're going to do with it. Take a look at these numbers. So now we're going to show you the changes that we're going to make. And the changes that we're going to make here have nothing to do with the purchase price. We're going to leave that the same. It's a bank REO. They want what they want, so it has to be an all-cash deal to them for $6,450,000. All of this purchase information will remain the same. Okay, our gross income calculator will remain the same. Our gross remains the same, but the income is going to change. Okay, please notice the next to the last line here, other losses. Now before, This other losses figure was $488,721.60, comprised as follows: $403,170.45 for concessions, $36,385.04 for loss to lease, and $49,166.11 for bad debt, totaling $488,721.60. Well, we're going to get rid of the concessions is what we're going to do. So the concessions figure now goes down to $205,150. That's $205,150. And that's based on a 50% turnover in tenancy every year with 1 month free for each new tenant. We still have that much, $205,150 plus $35,916 lost to lease and $48,532.30 on bad debt. So our new number here is $289,598 if we simply get rid of a lot of the concessions that have been made previously. Okay, our next line item here is the electric bill. And you'll see that the electric bill down here is a lot cheaper than it used to be. The old one was $275,425. Now it's down to $216 because we intend to make a contract with the electric company for a flat $18,000 a month, and they're going to be willing to do that. So $216,000 versus the old $275,425. If we go on a monthly contract, we can cut that down, and that's exactly what we're going to do. Now the next line item is repairs and maintenance. Repairs and maintenance used to be $139,519. The industry standard is $330 a unit, so that is $123,090. So our new number is $123,090, so we can save about $16,000 there. Now the next line item we're going to save quite a bit on, and that is the payroll. Once again, we have a company with a tremendous amount of payroll here that they are carrying. The old payroll figure, if you recall, was $429,737. However, the industry average is $750 a unit per year on the payroll. So we're going to do it at that rate, which brings it down to $279,750. So we're saving $150,000 a year there. Okay, just on the payroll. So this changes our bottom line numbers tremendously. Our net operating income has gone way up here. Now it's $886,270, and our annual debt service is $315,82. And our debt coverage ratio now is 2.8, and our cap rate is 13.74, and we're making almost $50,000 a month just by doing those things. Our cash on our annual return here is $571,088. Going down to our financial indicators here, our cash on cash return is now above 20%, which is our magic number, 26.37%. You'll notice that the operating expense ratio is still really high, 62.01%, and our internal rate of return has jumped up all the way to 46.14%. So just by purchasing the property at the price the bank wants for all cash and making these 1, 2, 3, 4 changes in our management of the property, we come up with a transaction that will work to the benefit of all concerned. And this will be a much more profitable venture. So that's the story on Texas 11-057. Another profitable venture gained through the process of proper management and negotiation.
So with a little work and a little time and a little effort and a little energy, we can get those cash-on-cash returns north of the magic 20% line. That's what we do with these properties, and that's why we're in the business. My name is Clark Wilson, and here's my contact information.